And one of the things that we've been saying all year is that the high yield market is no longer cheap, right? But it's not rich yet either because, we're in the later stages of a credit cycle. But the real question for everybody is how long is that stage going to last, right? And, central bank policy, the stabilization of the economy and, this kind of inflation, deflation environment is the high yield market still a 5 to 6% asset class. It was been bouts of volatility in January and July and then obviously in the last month. But it's still up 4.5% for the month. For the year.
So when we saw credit sell off, as equities did a couple of weeks ago, what were you thinking?
Yeah. Well, when you look at the real sell-off that happened, there were a couple of key things that were going on, right? So you had a global slowdown that everyone started to adjust to. And then you had the real move in the commodity prices. And so when you look at the actual credit, the entire market, it was really the real sell-off was specific to a couple of sectors, metals and mining, the energy and oil related, as well as retail. Everything else, faded, but there's been a strong bounce in as well.
Were you panicked in terms of liquidity 2 weeks ago when everything started to crack? It seemed like people were racing for the door in terms of credit. It made me feel like we're back to 2008. Is that the case?
No, there were some specific things that were going on in the credit market around liquidity, but in general, you saw a correction, right? There was a 5% pullback, then it escalated to a full 10% correction. That affected all markets, not just the credit markets. You saw that in equities. You saw a move in rates. The credit market was sell-off, and it was severe, but there was a stabilization that went on.
But are you concerned? Is there enough liquidity in the credit markets now, given how much money you manage? It's like moving the Titanic. Can you actually get done what you need to make a difference for BlackRock when there's so much less liquidity today than there was a few years ago?
Yeah, I think we always take the perspective that there is a higher level of trading cost, right? And you have to put that in your credit investment process is understand what the cost of liquidity is coming out because liquidity is fine up until when you need it. And so when you look at that, we take a longer horizon with regards to what's our investment thesis, right? And so I thought the sell-off and the correction was actually healthy. It created a little bit more discipline in the market. It got rid of the complacency in the market, and it created some opportunities.
But after an episode, an experience like that, spreads are widening out while it's happening. And they've tightened since then, but are they wider now than they were before we went into that period of heightened volatility? And if so, are they going to stay there?
They are, but they're very specific. It's really wide is on those three sectors, right? Metals and mining, energy, as well as retail. That is where you've seen the correction that is.
I was just wondering whether it sort of taught people an experience about the price of liquidity. Maybe they didn't really know what it should have been heading into that little episode. Now they got a better idea.
Yeah, I think it's the price of liquidity, but it's also the price of risk, right? So understanding that there's not complacency in the market and there's more discipline around it. You are in the later stages here. The valuations in credit were full. The valuations in equities were full. And so you introduced new risk in the market. You had a global slowdown. You had the Ebola risk started to heighten, in which case you started to see a correction back in the market. So liquidity is certainly something that people have to understand when they're pricing in the risk of assets and what their investment thesis is about when their exit is going to be.
Now that we are in this so-called latter stage or late innings of this baseball game, what are you going to do, right? You're naturally long. There are lots of people who specialize in distressed assets who are beginning to lick their lips, right? Looking at a deterioration of credit standards, the probability that defaults are going to rise, opportunities that will come their way to pick up things on the cheap. Not so easy for you, is it?
Well, I think it's about the mix of the portfolio. We run a variety of different styles for our different clients. I think the distress cycle is probably a bit of ways here just because when you look at the stabilization of the central bank policy globally, the Fed is starting to shift, but it's going to be a longer horizon. You look at the credit standards, they are easing, and it's certainly more issuer-friendly. That being said, most management teams have been pretty conservative over the last several years, the same way investors are. You have high interest coverage ratios. You have low debt and leverage. So, it's hard to see defaults really spike up, and that's why they're really around 1% right now. So I think the distressed opportunity is going to be there, but it's probably a couple of years away before it really starts to come into fold. But around a regular portfolio, most of our investors, it's what is the opportunity in high yield? When 80% of the assets around the world in fixed income trade less than 4%. So high yield at 5 to 6% is providing an alternative for many investors. And the loan market is even less volatile. So we like the asset class right now, not as an opportunity, but as something that is strategic in people's portfolios because it does provide less interest rate risk and less volatility than the equity market.
What are issuers telling you? What do you think the new issue calendar is going to look like from today to year end?
Obviously, when there's volatility, the new issue calendar slows down a lot. But you also have earnings, right? So there's a blackout season where people don't normally come to the market. I think you'll start to see the calendar start to come back as you start to see the stabilization in the market. And I would expect the next month to be fairly sizable. But we don't see what we saw in '07 where you saw the huge private equity deals and the big LBO deals. And so a lot of the deals you still see are refinancing and continue to push out the calendar. You do see some M&A activity and some shareholder-friendly activity. But to a large degree, the calendar is not going to be substantial.
Jim, you mentioned that credit, high yield in particular, and maybe some of those bank loans, certainly the bank loans, less subject to interest rate risk than certainly the Treasury market would be. But how does the normalization of Fed policy, which we might see by the end of this year, affect the way you invest?
Well, I think you have to look at the normalization of the policy, but as they're doing it, what does that mean for the whole economy, right? And what's the relative value to other assets you can invest in, right? Cash gets you 0 right now. Fixed income securities get you 2 to 3%. And so as they're normalizing, what does that mean? How is the economy doing? What's the health of the economy and the health of the growth in the market? And so in an environment where you start to see an improving economic environment, and that's what's driving normalization, that tends to be good for equities. It tends to be good for credit spreads.
Bill Gross leaving PIMCO, how's it affected your business?
Well, we haven't really focused on the Bill Gross with regards to PIMCO and credit. I mean, we're looking at the markets right now with the quality of the earnings and the quality of the companies that we're invested in. And so, what you've seen is not a lot of volatility around the markets. The volatility has been focused with regards to, this global slowdown.